Welcome to TalkTickers. We're the show that cuts through the noise of earnings calls to give you the highlights, the need-to-know info.
That's right. Think of us as your quick guide.
And today we're digging into Fluence's first quarter 2025 conference call. They're a multi-state operator in the cannabis space.
Yep. Our job here is to walk you through what the management team reported, what they emphasized. We'll pull out the key financials, the operational stuff, wins, challenges, and how they see things shaping up.
Okay, let's dive straight in. First up, just the snapshot. The Q1 2025 results. How did the top line look?
Total revenue came in at $26.7 million.
Okay, $26.7 million. How does that compare?
That's actually up. 5.9% higher than the same quarter last year, so some growth there.
All right. And moving down the P&L, what about profitability? Adjusted EBITDA?
Adjusted EBITDA for the quarter landed at $3.5 million.
And adjusted gross profit. That's always an interesting one.
Right. So adjusted gross profit, basically revenue minus cost of goods, with some adjustments, was $12.5 million.
Which as a percentage of revenue is?
That works out to 46.8% of revenue. It's worth pointing out, though, that last year, Q1 2024, that margin was a bit higher, 48.6%.
Okay, so a little bit of margin pressure there year over year.
Seems like it, yeah.
Now, the balance sheet, I saw a pretty big number jump out for cash.
Oh, yeah. That was significant. They finished the quarter with a cash position of $30.7 million.
$30.7 million. Wow. Compared to last year.
It's a huge leap. A year ago, end of Q1 2024, they only had $8.5 million in cash. So quite a change.
Definitely. But then looking at cash flow from operations, that seemed to go the other way.
That's right. Good catch. In Q1 this year, they actually used $1.5 million in cash from their operations.
Used $1.5 million. And last year?
Last year, Q1 2024, they generated $4.1 million from operations. So yeah, a noticeable swing from generating cash to using cash in the quarter. Management did give a reason, though.
Okay, we'll definitely circle back to the why on that one. Anything else on the balance sheet basics? Debt, shares?
Yep, quickly. Total debt is sitting around $79.1 million, and shares outstanding, roughly 700 million.
Got it. Okay, so that's the high-level picture. Now let's get into the details. What did management say was behind these numbers? Let's start with that revenue growth, nearly 6%.
Well, they stressed that this growth happened even with some pretty significant headwinds, especially in Florida, which is, their home base, their biggest market.
Headwinds like? What kind of challenges were they talking about in Florida?
They were pretty specific. Increased price compression, so prices coming down, and just ongoing market saturation. Lots of competition.
Right. So growing revenue at all in that environment is, well, it's something.
Exactly. That 5.9% looks maybe a bit more impressive when you consider that context.
Makes sense. And the adjusted EBITDA, the $3.5 million. How did those Florida issues and maybe other things factor in?
Management pointed to a couple of main drivers. First, they're still spending money on getting things up and running in New York, startup costs, ramp-up investments, specifically tied to that RIV acquisition they did.
The RIV deal.
Right. That takes investment up front. And second, they did mention again that sort of continued softness in the Florida market impacting the overall profitability.
Okay. Now let's talk about that cash pile. $8.5 million last year to over $30 million now. Where did that come from?
Yeah, that big jump is almost entirely down to the RIV acquisition. That deal brought a significant amount of cash onto their balance sheet.
So it wasn't operational performance driving the cash buildup?
Not primarily, no. It was the structure of the RIV deal. And management was keen to highlight this, gives them a lot of flexibility, not just for day-to-day stuff, but for longer-term growth.
And by long-term growth, are we talking building more stores or?
They specifically mentioned the potential for more acquisitions, M&A.
Interesting. So with that much cash and hearing management say some competitors are struggling.
Exactly. It puts them in a potentially strong position to buy assets, maybe pick things up if others are forced to sell. The market's still consolidating,
Right. So that cash is definitely something to watch. Okay, back to the operating cash flow. Using $1.5 million versus generating $4.1 million last year, you said there was an explanation.
Yes. They clarified it wasn't just about this quarter's operational spending. The main reason for using cash from ops this quarter was apparently settling some obligations, some liabilities that were carried over from previous years.
Okay. So more like cleaning up old accounts payable or something like that, rather than a sudden downturn in the core business generating cash.
That seems to be the explanation they gave, yes. Makes the swing feel a bit less dramatic in terms of underlying performance for this quarter.
Got it. That definitely helps clarify. Okay, let's switch gears to what's happening on the ground, state by state. Florida first. What's the latest there besides the market pressure?
Well, some key developments. They finished building out their Rosa cultivation facility down in Tampa. That's a big deal.
Plants are in.
Plants are in, yes. And they're expecting the first harvest from Rosa around August this year.
Okay. Any retail updates in Florida?
Yep. They moved a dispensary, relocated the North Miami Beach one to Ventura. Management said this was about improving the patient experience, getting more storage, but also, importantly, moving closer to what they believe is a more profitable area.
Makes sense. Location, 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 right?
Pretty much. And on the product front in Florida, they've been active.
Oh, yeah. What's new?
Launched 2 new brands for whole flower. One called NAC, positioned as quality but affordable. And another, BGO, which is more value-focused, comes in larger formats.
Trying to hit different price points.
Exactly. And they also launched their first single-serve edible product. It's a 10 milligram THC chocolate bite.
10 milligram THC. That's a pretty standard dose for edibles, lower entry price point maybe.
That seems to be the idea, yeah. Make it easier for people to try. Overall, management sounds like they feel they're making progress on improving flower quality and really carving out distinct niches for their brands in that competitive Florida market.
Okay, Florida covered. Let's head north to New York. Big focus area after the RIV deal, as you said. How's the integration and ramp up going?
Sounds like pretty well, based on their commentary. They highlighted significant improvements at the Chestertown facility, which came with RIV.
Improvements like what?
They said they cut about $400,000 from operating expenses, the day-to-day running costs, while, get this, nearly doubling the output from the facility.
Cutting costs and doubling output. That's impressive.
Right. And they also stressed quality improvements, saying harvests are consistently hitting THC levels over 30%.
Which is considered pretty high, right? A sign of good cultivation.
Generally, yes.
Yeah.
It suggests they're getting the processes dialed in there. Seems like a positive sign for the RIV integration so far.
Definitely. What about their other big New York project, the Buffalo facility?
That one's moving along too. The main structure is complete. Now they're installing the internal systems, dehumidification, fertigation, all that technical stuff needed for growing.
Timeline for Buffalo.
They expect to get plants in there by mid-June, so pretty soon. And they're anticipating the first harvest out of Buffalo in the fourth quarter of this year, Q4.
Okay. Any new products launching in New York?
Yeah, they brought that NAC brand, the affordable quality one from Florida, into New York, starting with pre-rolls. And they expect to launch infused pre-rolls there within about 30 days.
Got it. Spreading the brands across states. Makes sense. Okay, beyond Florida and New York, did they talk about other states where maybe regulations could change things? Like Texas?
They did. In Texas, they said they were watching things very closely, specifically mentioning House Bill 46. That relates to potentially expanding the state's medical cannabis program.
And Fluence position there.
Management basically said, we're ready. They feel positioned to expand their operations quickly in Texas if the rules become more favorable. They also mentioned construction on their Houston education, and pickup center is almost done, expecting to open that in Q3.
So laying groundwork. What about Pennsylvania, another state often in the adult use conversation?
Yep, Pennsylvania too. They're actively tracking the legislative progress there towards potential adult use sales. They see their 3 existing stores in PA as really important strategic footholds.
Kind of like flagpoles in the state, ready for expansion if it happens.
That's the idea, yeah. Positions them well if the market opens up.
Yeah.
And they said they're still looking for other growth opportunities in PA too.
Okay. So, stepping back, what was the overall message from management about the market and their strategy? The big picture takeaway.
Well, they definitely acknowledged the uncertainty out there. Macroeconomic pressures, regulatory questions. That's still the backdrop for the whole industry.
But their focus remains.
Pretty consistent with what they've said before. Strengthen the core markets like Florida, manage costs carefully. We saw that with the New York OPEX cuts. And just stay flexible, ready to adapt and grow as things change.
And how did they sound about their own position relative to others?
They sounded, I'd say, cautiously confident. They used phrases like feeling steady and strong. And interestingly, they specifically mentioned observing that some competitors are, in their words, faltering or falling aside.
That's a direct comment. Suggests they see opportunity in the current challenges.
It certainly implies they feel they're weathering the storm better than some others.
One other thing, usually these calls have a Q&A session with analysts afterwards, right?
Almost always, yeah.
But not this time.
Correct. Fluent finished their prepared remarks, and that was it. No live Q&A.
Interesting. Okay, so let's try to piece this all together. Thinking about this from an investor's perspective, or just someone trying to understand the company, what are the key implications?
Well, first, it puts those financial numbers into context, right? The revenue growth, even modest, looks decent given the Florida pressure they described. And the adjusted EBITDA reflects that pressure, plus the necessary spending in New York. It lines up with their stated plan. Manage Florida, invest heavily in New York.
And that huge cash balance, the $30.7 million, how crucial is that right now?
Oh, it's massive.
Massive.
Especially like you said with their comment about competitors faltering. Having that kind of cash on hand when capital might be tight elsewhere, a big strategic advantage.
For M&A, like you mentioned, potential war chest.
Absolutely. It positions them as a potential buyer, a consolidator, in a market that probably needs more consolidation. That's a key takeaway for sure.
What about the updates from New York? The cost cuts, output increases.
Those are really important proof points for the RIV acquisition. Investors needed to see that they could integrate those assets effectively and start generating value. Seeing operational improvements like better efficiency, higher THC levels at Chester, that's tangible progress. It's a key performance indicator, really.
Yeah, and their moves in Texas and Pennsylvania.
That's about future potential. It shows they're not just focused on today, but trying to position themselves for where the market might go. If those states liberalize their rules, Fluent having a presence or being ready to expand could pay off significantly. It's about being prepared for those regulatory catalysts.
Okay. And lastly, the fact there was no Q&A, what signal might that send?
It's hard to say definitively. Could be nothing. Maybe management felt everything was covered. Could be they wanted to avoid certain tricky questions, though that's speculation.
Or maybe analysts just didn't have burning questions this quarter.
Possibly. But for anyone listening, it just means you have less information to work with, only the prepared script, none of that back and forth clarification you usually get from a Q&A. It leaves a bit of a void.
Right. Okay, this next bit, just to be crystal clear, this is not financial advice. We're just talking, exploring ideas based only on what Fluence management said in this specific call. It's purely for informational, maybe entertainment purposes.
Absolutely. A thought experiment, nothing more.
So, based only on their narrative competitors faltering, Fluent feeling strong, the big cash pile from RIV, the New York progress, the positioning in Texas and PA, here's a kind of outrageous, but you can see the logic trade idea someone might hypothetically consider.
Okay, I'm listening. What's the outrageous idea?
It's a relative value play. The thinking goes, if Fluent is strong and others are weak, maybe there's an opportunity there. You'd first have to identify a publicly traded competitor that seems to fit management's description of faltering, maybe based on their debt load, their own results, lack of diversification, something like that.
Okay, find a potentially weaker peer.
Right. Then the speculative trade would be to short that competitor's stock, betting it will underperform or go down while at the same time going long Fluent. Either buying Fluent stock directly or maybe using long-dated call options for leverage.
Ah, so you're playing the difference. Betting that Fluent will outperform the weaker competitor, maybe significantly, creating a widening gap between the two stocks.
Exactly. You're betting on Fluent's stability, their cash, their New York execution, maybe a boost from M&A or those regulatory catalysts in Texas or PA, causing their stock to do much better than the company you've shorted.
The divergence trade. Makes sense as a hypothetical based on their commentary.
But again, purely hypothetical. Based only on their story this quarter, this kind of trade is complex, risky, needs tons of research, and is absolutely not something we're recommending, just an idea floating out there.
Definitely not a recommendation.
Yep.
And it's vital to remember this whole conversation hinges entirely on the information Fluent chose to present in their earnings call. We're summarizing their narrative, not validating it or suggesting you act on it.
Precisely. This is just a starting point for your own thinking. You absolutely need to do your own homework, dig deeper, understand all the risks the cannabis sector is notoriously volatile, and maybe talk to a qualified financial advisor.
Couldn't agree more. So a quick recap of the main points from the Fluent call. Revenue grew despite the Florida pressures. Big focus on New York investment and integration post-RIV, showing some positive operational signs there. Cash position dramatically improved, opening doors for potential M&A, and they're keeping an eye on and positioning for potential rule changes in Texas and Pennsylvania.
So that's our breakdown of Fluence Q1 2025 call. What were your takeaways? Did anything jump out at you that we didn't cover? We'd love to hear your thoughts.